In the year 2020, India saw a huge influx of option traders. Because of COVID, a lot of people thought stock market can be their secondary source of income. During this time, while people started entering options, while most of them started buying options, there were a bunch of them who also started selling options. And slowly and steadily, within the next 1.5 to 2 years, option selling became very popular because during these 2 years, it delivered consistent returns. And the most popular strategy out there was the short straddles. So, short straddle is a simple option strategy mostly done for non-directional market. So, today in this video, I'm going to break down this entire strategy of short straddle. So, you might have seen a lot of videos where they have already taught the strategy, but in this video, I want to get into the intricacies of it as a trader. So, I'll be teaching you how to do it, when to do it, and when to avoid doing short straddles. So, this is what we are going to cover in today's video of First Talk. Make sure before you continue, you hit the like button, share this video, and also subscribe to the channel. So, before we continue, here are some prerequisites which you must know before moving on with this video. The first one is you should have a basic understanding of how option buying and selling works, and you should also have a basic understanding of option payoff graphs. So if I am showing you a payoff graph, you should know what is POP, or probability of profit, break-even points, standard deviation. So you should have at least have a basic idea about that. So we'll touch base upon that, but it's better if you already have an idea. So next, you should have an understanding of option premiums and IV. So what exactly is IV? How exactly IV works? In case even if you don't know, we'll touch base upon the same, but we'll also be making a detailed video on IV because the concept of IV in itself requires a whole detailed explanation. So these are some of the prerequisites. Even if you have most of it, it should be fine. So with this, you'll be able to understand the video much better going forward, right? So we'll start with the formal definition of what are short straddles. So short straddle is a neutral strategy where you simultaneously sell a ATM call and a put. Both options must have same underlying asset, same strike price, and same expiration day. It is a volatility short strategy, meaning you profit when the market remains stable or volatility decreases. So the reason why I told you should be knowing about IV is because of this last line. So it's a volatility short strategy. That means you make additional profit or you make really good money when the IV or volatility decreases or remains stable. So if we were to take a look at this practically, for this, let me open the strategy section in the First Talk's new terminal. By the way, if you're new to First Talk is a new age broking platform specifically built for option traders. So you can actually analyze your trades, enter your positions, adjust your trades, do everything from a single platform. It is very smooth and very fast to execute. In case if you're new to this or hearing it for the first time, I would definitely urge you to check it out because once you get into this, I'm pretty sure you're not going back. So this is specifically for option traders, and in case if you're an active option trader, do open your First Talk account today by clicking on the link in the description and try it out firsthand yourself. So with that being said, let's get into short straddle. So as per the formal definition, we know that it has to be of the same underlying. In this case, we have chosen Nifty 50. It should have the same expiry. In this case, it is Jan 6, 2026. And then we have to sell the same strike, call and put. So theoretically, short straddle is considered to be a range bound strategy where you expect the market to stay in a particular range to actually make profit from it. So if you end up selling the ATM call and the ATM put, so let me save it as SS1. So I have created a strategy and saved right over here. So you can see this particular strategy currently is a range bound strategy where the break evens are 26,158 and 26,441. So we nearly have around 150 points on the higher end, 150 points on the lower end, and almost a range of 300 points. In this case, since this is a range bound strategy, so that means we make money only if the market actually stays in the range. So if the market is very volatile going out of the range, then you will be having M2M losses. And that's why it is said that you only make money if the volatility is stable or is decreasing. If the IV shoots up, this strategy is again going into a loss. So we'll discuss more about that later on. But I think with this, you should be clear about what exactly is a short straddle. So next, moving forward, how you can actually create a short straddle. So first, before we end up creating a short straddle, so you can only create a short straddle with two of these being satisfied, or at least one of it being satisfied. The first one is the underlying has to stay within the break-even points. So what do I mean? If you expect Nifty to go beyond this, so right now Nifty has just hit an all-time high and it is about to break all-time high. If you expect the market to trend, if you expect the Nifty to go much higher from here, then short straddle is not a strategy that you should be using, right? So this is mostly done in case if you expect the market to stay range bound or in a particular range between the break-even points. Or the second point is when you expect the realized volatility to be lesser than the implied volatility. So what do I actually mean by that? What is realized volatility being lesser than the implied volatility? If you take a look at this, market is offering a range of 300 points, expecting the market will be volatile to a certain extent. So you can also check the IV of Nifty 50 on the First Stock platform. If we go to Nifty 50 and F&O analysis, so as we scroll down further, so you can see the ATM IV right over here. So based on the expected volatility from the market is pricing in the option to a particular extent. It can happen that markets can move much lesser than what is actually priced in, or can move much higher or much more than what is actually priced in. So it might happen in case of a budget. So market will generally be expecting a huge move up or down. But if that move doesn't come, automatically the IV will start to shrink. So why it will shrink? Because the market is not moving to an expected range. So suddenly maybe during April 7th, what happened? So April 4th, overnight, Trump had announced he's going to impose tariff on all the other countries. So overnight on a Monday, market was not really expecting that kind of move. So that day, the IV ends up shooting much higher. So the IV of the options will end up shooting, or the realized volatility will be much higher than the expected volatility. So similarly, if you already know about an event, something like elections coming up, or say US elections coming up, in such cases, the IV will already be higher because we are already anticipating a move. But if such moves don't come, then IV is going to drop, option premium is going to shrink. So that's why if you expect that right now market is pricing in a particular IV, but the actual movement of the market is going to be lesser than that. So the expected or the realized volatility is going to be lesser than the implied one. Then you can further make profit from trading straddles. Even though the market is moving, the option premiums will end up getting crushed. As I told, we'll make a separate video on that. But for now, I just want you to know, even it's okay, even if the market starts to trend, if the IV falls, option premium doesn't go up so much, right? This is another important thing which you should note as an option trader. With that being said, the final one, which a lot of people don't really talk about, is pick the direction. So you might ask, Saket, you just told it's a range bound strategy, then what does picking the direction really mean? So what we have created right over here is a range bound short straddle. So in case if you had a slightly bullish view on the market, so then you can also create a slightly bullish short straddle. How can you do that? You can simply short some ITM puts followed by some OTM calls. So here you can see that I have created a 26,400 short straddle where I have collected 96 from put and 42 from call. So I will just name it bullish short straddle, BSS, right? So now you can see my break-even points are much higher than my previous ones. So previously the break-even was 441, but now the break-even is 538. But with this, what I should also note is my lower break-even also would have shifted higher. So my previous strategy had 26,158. This current strategy has 26,261. So almost 100 points higher. So this way, if I am further bullish, I can also end up creating a much higher short straddle or much lower short straddle depending on what my market view is. In case if you are expecting bullish to range bound, slightly bullish, right? In such cases, you can create a bullish short straddle. Bearish to range bound or slightly bearish, you can create a bearish short straddle. So if you're expecting the market to stay in a particular range, then range bound short straddle. So you can also use the standard deviation as one of the indicators to see statistically what is the probability of market moving. So wherever you see 1 ST, so here you can see 1 ST, 1 ST, 2 ST and 2 ST, right? So just by looking at this, you know that if you are considering a ST level of 1, that means there is a 66% chance the market is actually going to trade between -1 ST and +1 ST before the expiry. So that means you can see the current ST1 is 26,551 and 26,105, right? So that means there is a 66% chance the market is actually going to trade in this particular range. So you can see that right from here. Then 2SD range is 26,774 and 25,883. So there is a 95% chance the market is going to trade in the range of these two. So -2 ST2 +2 ST. So 95% of the times market is going to stay within that range. 66 or 67% of the times market is going to stay within the range of -1 ST2 +1 ST. So this is what the statistic says. So that's why we have also marked the ST1 and ST2 right over here. So statistically you can see what is the expected move from the market. So if this is statistics, so you can also use your own discretion to judge the trend of the market and accordingly size your positions or accordingly choose the direction. So when it comes to creating a short straddle, very simple. First, you pick the direction. So you need not always keep it range bound. You can sometimes make it slightly bullish, slightly bearish. After you pick the direction, it should satisfy one of the things. Either you expect the underlying to stay within the break-even points, or you expect the realized volatility to be less than the implied volatility. So we have already discussed what it is. So again, when do you create? Okay, this is short straddle, so it has come out as spreads. So this is when do you create short straddles? So you can create short straddle first in a high IV environment. That means we already discussed during elections, during budget, during maybe right after the Trump speech of US imposing the tariff. So all such cases IV would have shot up. So whenever IV shoots up, eventually it will cool down. So whenever the IV gets crushed, that is the best time for an option seller to make money. So that's the reason why 2021-22 period was very easy for option sellers is because during the COVID crash, IV had shot up to 80. Generally, the IV is going to be anywhere between 10 to 15, but the IV had shot up to 80. And because it was at 80, so option sellers had a fantastic time because they were just shorting, market was not moving so much, and they used to get really good money back in return. And suddenly it became harder for the same reason. So now market started to price in the right IV. It is going to become extremely hard if the actual volatility or the realized volatility is much more than the implied one. That means every time market is not giving you enough premium as an option seller to make money. So high IV environments is one of the good places to start off with. Your chances of or probability of profit is also going to be higher because the premiums are higher. Sideways market. So for a long period of time, if you take a look at it from the last 2.5 months, market is in a very tight range between 26,300 on the upside, 25,700 on the downside, almost around a 600 point range. So in such tight ranges where you can create something like a 26,000 short straddle and hold it till the breakout happens on either direction. So this can be one of the thought process which you can use. So if you are expecting the market is trading in a range for a very long period of time, then you can use short straddles to make the best out of it. So if we were to come back to first talk, nothing much has happened from the last 1, 2, 3, 4, 5, 6, 7 to 10 weeks. No much movement has happened. So market is literally stuck in and around 26,000. So whenever such kind of range bound market or sideways market is expected from your end, so you can also end up creating a short straddle. Third one, post event trades. So we already discussed why exactly it is going to be useful. Again, because of the high IV, it gets crushed and you can make money, and high conviction in the stability. So if you are expecting markets to stay in a range or slightly be bullish or slightly be bearish, then if you have good conviction on your market view, on your stability of the overall market, then it is going to be quite good. So if there is an event coming up, let's say in next month we have the budget coming up. So now even if you have best of the best conviction, the IV is eventually going to shoot up, and it won't be the best time to sell options before the budget. Maybe after the budget, IV is going to get crushed and you might get really good uh, opportunities, but not before the event as a seller. So these are some things which you should know. It is not that you just come create a short straddle whenever you want as a discretionary option seller. So there are two things: how much time is left in your hands, how exactly the market is moving, and what is the volatility expected in the coming week or coming month or time till expiry. So your expectation can be sometimes right, sometimes wrong. So there is no right way to tell that this is going to be the right volatility or this is how volatile the market is going to be. It is just based on yours and my expectation based on our previous experiences. So I think this should have given a clear idea on when to create a short straddle, and also what exactly the standard deviation on these two represent. So what is the probability that the market is going to stay in a particular range is expressed by the standard deviation lines on your payoff chart. So apart from that, you can see that it is showing the probability of profit is nearly 57%, and what is the margin required, what is the risk to reward, and so on. So we'll come back to these things, maybe the delta probability of profit in some other video where we try to dive deep in, try to understand the standard deviation and so on. So for that, so we will be able to make more such videos if we see that we are able to add value to you. You can also support us in turn by subscribing to the channel and also liking the video. So please do share it with your friends, all the people in your community, to make them aware about how exactly things work in stock market. So with that being said, we will also discuss about the last part, when to avoid, right? So low IV is not a great way or not a great time to sell options. So right now the IV is very low. So sometime IV was almost around 8 or 7. So that is a very low IV, and definitely market is going to move much more than 7% in a year, right? So it is not going to just stay in a 7% range. So using this IV, it is okay to trade for expiry. It is okay to trade weekly also. Maybe if you are going for a quarterly option, IV is very low, premium is very low, you are not being compensated correctly for your risk. Maybe if you are going for a yearly option, not a great time at all, right? So IV is very low and not a great time to be shorting yearly options, right? So you have to make use of it when the IV increases, not when the IV is lowest. So when the market is trending or market is giving a breakout, again a very bad time to enter short straddles, because end of the day they only make money if they are in a range. If it is trending up or down, you won't be able to make money. And then earnings today, a clear avoid. So if there is earnings today, there can be a big move up or down. So it must be clearly avoided. And finally, a risk averse trader. So it requires constant management, a lot of things to be done, right? So I'll also be continuing this series with how you can trade a short straddle, adjust a short straddle, and much more going forward. This is just the first video in the short straddle series. So we'll be trying to make anywhere close to around 4 to 5 videos where we'll try to cover all the aspects along with Greeks, IV, and much more. So then if everything is an avoid, then when should you do? We have already discussed. Generally a high IV rank. So whenever the IV is high, so that means you have a good time to create a short straddle, right? So it is, again, it's written proceed with caution, or we have added proceed with caution, because short straddle is mostly not for, say, conservative traders. It's mostly for aggressive traders who are ready to take additional risk for additional return. So it is mostly to be done by traders who are willing to take extra risk, who are trying to capture every bit of the premium what is left, who is trying to make the best use of the theta decay, IV, everything put together. It is for such people and not for people who want to trade in a conservative way. So that's the reason this is one of the best times to do a short straddle, because when the IV is high, that's when the decay of the options is going to be the highest. So you proceed with caution, because high premiums will come with its own high risk. So one, the idea of getting crushed, but also on the other hand, if IV further increases, it is going to have its own risk. So broadly speaking, in today's basic video, we have tried to cover multiple things, starting with how to do a short straddle, when you should do a short straddle, how you can also do a directional based short straddle, right? And finally, when to avoid doing a short straddle. The reason why I am doing this video today is to tell you that we have the budget coming forward. So in case if you are carrying any positions, be careful about the IV shooting up. So if you are carrying the quarter end or year end short straddle, or if you intend to do that, right? So post budget, the IV is going to get crushed. So then you're going to get some good opportunities to actually create a short straddle. So again, I can't be telling about which direction, whether it is going to stay range bound, because those will be coming under the purview of me giving a recommendation. But one good part about this first stock application is I kept on telling about IV. How do you know if the IV is high or low? Just come right over here, see the IV of the options. So generally IV will be in the range of 10, 12, 15. So anything greater than 15 is considered to be higher, on the higher end, and anything lesser than 10 is considered to be very, very low. So today there were points when IV was just around 8, 7 and all. So this is a very low IV, and anything 15, 16 or above 20 is a generally considered to be pretty high IV. So anywhere around say 11 to 15 can be a range which you can consider as a normal IV, right? So IV is basically the expectation from the market participants about how much the market is going to move, and based on that you are given a particular premium to trade with. So this is our first video on introduction to short straddle, how to create it, when to create it. So we'll be making further videos to it on how to trade a short straddle, how to adjust a short straddle, and how to risk manage or position size your short straddle. So I hope I have been able to deliver some good value with this particular video. If you think so, make sure you hit the like button, share this video with all your friends, and also subscribe to First Talk. Thank you so much for joining, guys. See you soon in the next video.